The Nasdaq 100 seems to be attempting to break out above a 4-month consolidation. The index has made similar breakouts in recent years, like here in 2021, which led to a rapid 16% move up in tech stocks, and here in 2019, which also led to a rapid 17% run higher on technology stocks. So is the breakout we're seeing today also suggesting that the rally in US technology stocks is getting ready to accelerate higher, and that these stocks are once again ready to outperform the rest of the market? To answer that, we can look at this chart right here, which shows us the relative performance of the Nasdaq 100 against the S&P 500. So we're looking at how much the tech sector is moving up or down against the main US stock market index, the S&P 500. When this line goes up, it means that tech is outperforming the S&P 500. And when it's declining, then the S&P 500 is outperforming tech. Now, since 2002, after the dot-com bubble completely devastated technology investors, tech stocks have been systematically outperforming the S&P 500. The Nasdaq 100 has outperformed the S&P 500 by more than 260% over this time period. So to many investors, tech is an easy way to make a lot of money. A lot of people just assume the Nasdaq 100 is naturally going to continue outperforming the S&P 500. In 2022, you can see tech stocks had a big wake-up call when the Nasdaq 100 underperformed the S&P by 20%. But since the beginning of 2023, we've seen a resumption of this tech outperformance. Now, since June of 2023, we've had a sideways trading range of tech against the S&P 500, which means no real outperformance or underperformance during this period. Of course, there are stocks like Nvidia that have performed a lot better than the S&P 500, but the tech sector as a whole has not outperformed the S&P 500. One could argue that the last year or so of price action has just been a consolidation of the big gains that we saw at the beginning of 2023, and that the tech sector might be getting ready to see another big move up like it did in early 2023. But there is a key difference between today and the beginning of 2023. Back then, tech stocks were a lot cheaper. When we look at the average PE ratio of tech stocks, which is basically a measure of how expensive they are, we see that in early 2023, they were trading at a PE ratio of 19, which is actually pretty reasonable. Today, their PE ratio stands at almost 30. That's about 50% more expensive. So you're definitely paying a significant premium to own tech stocks today relative to January of 2023. If we add the S&P 500's PE ratio on top, so we can compare how expensive tech stocks are relative to the rest of the market, we see that there's a big gap between tech and the rest of the market today. This is not a gap that was present in January of 2023. So this is the argument to say that tech stocks could struggle to continue outperforming the S&P 500 and could actually be vulnerable to continue underperforming it. Of course, there is a very obvious counterexample on this chart from 1999. Look at how big the gap between the technology sector's valuation and the S&P 500 got back here. This was fueled by excessive optimism around tech stocks in 1999, what was known as the dot-com bubble. Many argue that artificial intelligence is fueling a similar kind of environment today. However, we could also say that this gap in valuations that occurred in 2020 was similar to today. In August of 2020, tech stocks were trading at around a PE ratio of 30, while the rest of the stock market was trading at a PE ratio of 23, very similar to today. When we look at the performance of tech against the S&P 500 during this period, we see that August of 2020 marked a pretty important peak in tech's outperformance against the S&P 500. Back then, there was also a lot of euphoric sentiment around tech stocks following the pandemic, where most retail traders were considering tech as an investment because of the digitalization of the economy and remote work. But the problem was that it had already been priced into the market by then, leading to a tech underperformance over the 6 months that followed. So retail traders that were overexposed to tech stocks as a result of the digitization narratives from 2020 ended up underperforming the rest of the stock market. But even though tech was underperforming in early 2021, the market as a whole wasn't declining. In fact, the S&P 500 performed quite well during this period. It was just that other stocks were performing better than the Nasdaq 100. For example, in March of 2021, there was a big downside in tech stocks relative to the S&P 500, which coincided with a correction in the S&P 500 itself. But eventually, the S&P 500 did recover quickly, even though tech stocks continued to underperform. It's entirely possible we see something similar happen today, where tech underperforms while the market as a whole continues to climb. That's definitely what we've seen since July 2024. Now, if we zoom in a little bit closer on the recent price action, there's a key support line that traders can monitor. It could be dangerous if this ratio does break below it, because that could hypothetically open the door for a larger period of underperformance on tech stocks. The next big support on this ratio could be as far as 7% lower, which would mean a 7% underperformance in tech stocks. However, support tends to be support until proven otherwise. So it could be that the ratio tags the uptrend line and bounces like it did in August 2023 and September 2024, leading to a tech outperformance once again. The key will be to watch the reaction if the ratio comes down to the uptrend support line. At Capital.com, we'll continue to provide updates on such market developments. You can trade tech, S&P 500, and other stocks on the Capital.com platform. Thank you for watching.